Welcome to Mining Over Canada. Join the Canadian Securities Exchange and our partners in a first-hand look into our country's vast mining landscape. Experience its regions, meet the people, explore the history, and find out what comes next in one of Canada's richest industries.
You got a dream lineup here of the greatest minds in mining finance, so I'm going to stay out of it as much as I can and let the experts speak.
Great. Well, when he's talking about the great minds of mining and finance, he's definitely not referring to me. But I do have to say, after speaking with each of you, I feel like I have such a different understanding of the sector. I thought I knew a decent amount before, but wow, I feel like I gained so much from you. One-on-one interview with both Rick Rule and Frank Holmes, and my colleague Barrington Miller did an interview with Adrian Day. Those will be released this week on our YouTube page. I encourage you guys to go check it out, because hearing these guys individually is pretty spectacular, and I promise you'll gain lots from it. So thank you so much, all of you, for joining me. This is kind of an all-star panel. Thank you for your participation in this event and all of the valuable content you've brought to the table. I'm going to start off by letting you introduce yourself real quick. Let us all know what it is that you do. Just do a quick intro. Frank, why don't we start with you?
Hi. I'm known for the world of gold and now airlines. And I'm happy to be here and participate with my good friend Rick, who seems to be sitting quite high on all his gold bricks. That's why he's so tall there. But U.S. Global Investors is well known throughout the Canadian markets for investing at all stages of the gold industry. In all resources in particular, but we go from exploration right up to producing, and now been doing gold convertible notes. So I think it's wonderful to participate in this venue.
Thank you, Frank. So Frank Holmes is CEO and CIO of U.S. Global Investors, Inc. Thank you, Frank. Rick Rule, we'll move on to you next.
My name is Rick Rule. I'm the largest shareholder of and an employee of Sprott Inc., a Canadian domiciled investment manager. We manage about 17 billion US dollars, the vast majority of which is in precious metals and natural resources. We're equity investors. We operate precious metals commodities trusts, particularly gold, silver, and platinum and palladium on the New York Stock Exchange. We are also direct lenders to the mining business, particularly around development stage precious metals assets. In addition, we manage portfolios for a variety of high net worth retail investors and assist some other Sprott portfolio managers who have both retail and institutional client bases.
Adrian, what kind of introduction do you have for yourself, sir?
So anyway, my name is Adrian Day. Our firm is Adrian Day Asset Management. We invest in primarily, we invest in global equities, everything. But in the resource space, we're primarily gold, but we invest in other resources as well. And we invest in, like Frank and Rick, we invest in the whole spectrum, from the largest miners down to the smallest exploration companies. We also are the investment. I'm also the investment manager of a mutual fund, the Euro Pacific Gold Fund. So that's me.
Perfect. Thanks, Adrian. Let me just kick off this, and I'll start with you, Frank. Now, we've been about 8 months into this pandemic, and Richard had mentioned the value of gold and what has happened to it. I think it's holding around steady 1,800 right now. But where is the path for gold from here on out? I mean, the conditions are so volatile and unpredictable in this current environment, and I'm sure people just want to know throughout the panel, where do we go from here? What macro impact are we expecting on the price in the next 6 months, potentially? I mean, we're talking about vaccine, but is that going to hold back gold, or are people going to lean more into it?
Well, I think you have to look at macro factors that drive fear. And we're looking at economic models. And in this whole acronym of MMT, modern monetary theory, it's being practiced in the G20 countries differently in each of them. But one thing is for sure is that they operate, the central bankers, as a cartel. They have their own club. And many of these heads of central banks last longer than presidents do. And I think what's to me is interesting to watch is that in 2001, there was this sort of collection of, we have to drive global trade, and everything was about synchronized global trade. And then after 08-09, it became synchronized taxation and regulation. And now it's just synchronized money printing to fight this invisible war, the coronavirus. And that element is going to continue. Well, and you were talking about negative real interest rates. In Europe, you still have negative PMI below 50 in Europe. America's surging. China was first to start surging. And still with Europe lagging, they're going to maintain negative real interest rates. They're going to, same thing here. And what's very different is how the Federal Reserve is emulating the Central Bank of Japan and Switzerland that raise money and they just print it themselves, and they go buy equities or they buy ETFs. And on this cycle here, we've seen the Federal Reserve buy corporate bond ETFs, muni bond ETFs to drive down interest rates. So this different world makes it very, very attractive for those who are looking at gold as an asset class. And I think that's one reason why we see, but coming back on this thing on gold as an asset class, it's going to be volatile. And we have to recognize in the beginning of August, it was up 2 standard deviations, and now it's corrected, it's down 1. So we've gone this sort of swing. The dollar's getting stronger going into year end because of the election results, but that will fizzle. That will fizzle because the thesis of MMT will continue.
Rick, I'm sure you have a follow-up for that.
If the question is the same, yes, I think Frank did a very good job talking about the policy responses. My own experience has been the gold responds, as Frank suggests, primarily to fear, although he's a wonderful proponent of the love trade, which he may cover later. My own experience has been that gold moves primarily to fear, and primarily to fear of the ongoing purchasing power of conventionally oriented savings products. And I would suspect particularly savings products denominated in the world's reserve currency, which is the US dollar. I would argue that those fears are well-founded. First of all, quantitative easing, which if you and I did it would be called counterfeiting. The second being debt and deficits. I don't know the similar Canadian numbers, but the consolidated on-balance sheet and off-balance sheet liabilities of the US federal government exceed $150 trillion and grow by about $3 trillion a year. This must make people concerned about their savings. The third, of course, is negative real interest rates, which is to suggest the risk premium that you receive for your time preference, lending money to other people. Jim Grant famously calls the US 10-year Treasury return-free risk. And I would argue that gold is competing particularly with return-free risk, which I would suggest is a fight that gold can win. Frank talked about volatility, and I think it's important to note that both gold and gold equities are very volatile assets. The truth is that the gold equity indexes, not individual gold stocks, but the gold equity indexes can fluctuate by 15% up or down in a secular bull market with absolute ease. While these fluctuations may unnerve investors and speculators, they are part of the gold bull market. Finally, I would note that gold bull markets, as differentiated by recoveries from oversold bottoms, historically have been pretty great in terms of duration, which is to say sort of 10 years long. And also dimension, the equity indexes, not the best stocks in the index, but the equity indexes can give 500 or 600% performance over the 10 years that the average gold bull market takes. Now, what every investor, I think, wants is certainty, and I don't think that certainty is on offer. But I think if you add up the probabilities associated with the gold trade, that the probabilities favor the prudent investor and the prudent speculator, both in gold and gold equities.
Okay. And Adrian, anything to add to that worldview?
Well, both of my eloquent friends have really laid out the case very, very clearly, and I'm not sure there's an awful lot I can add, but maybe just look at it from my own point of view. I agree with everything both of them said. You know, first of all, there's so many factors that go into gold that we can look at. The dollar, you know, jewelry demand in China, central bank buying, central bank selling, and so on and so on. But to me, the core is what Frank and Rick both talked about, and that is the purchasing power of currencies. And again, I can't say the numbers for Canada, but in the U.S., since the U.S. went off the gold standard, finally broke the link from gold in 1971, gold has lost 86% of its purchasing power. The dollar has lost 86% of its purchasing power, which is why people are turning to gold. Now, is that likely to continue? That to me is the central issue. What are the central banks of the world doing? Are they going to continue with this excessively easy policy? And again, as both Rick and Frank in particular mentioned, that is, in all likelihood, is going to continue. Now, there's all sorts of factors that go into whether central banks are easing or tightening. And certainly the vaccine, if we have a vaccine that's, manufactured quickly, distributed quickly, and COVID goes away, certainly that is a negative. But there's so many other things that are supporting or pointing towards central banks' increase in their liquidity. And, we have a new incoming administration, most likely, in the U.S., Janet Yellen as Treasury Secretary. Janet Yellen is the epitome of excessive ease, and so with an accommodative Treasury, even more so than the last guy, Mnuchin, and an excessively accommodative Federal Reserve, this is only going to continue, in my view.
Okay, and I appreciate those comments. Now, you guys, I'm only going to simplify this now. You're all pro gold, but for the foreseeable future. But I guess the question I have, because I want to kind of bring this back to the end investor, the retail investor specifically, and I know Frank and you guys alluded to it a little bit, but what is the one product that you look at now and go, that's a great entry point for gold investment? That is a great starting point. Can I start with you, Frank? As succinctly as you can answer that question.
I'm sorry, the question is?
What would you invest your first $1,000 into gold? Would it be a gold ETF? Would it be trying to get physical gold? Would it be a stock? If so, what would you go for?
I would probably buy a gold royalty stock. You have their stomach more volatility, but you have the highest revenue per employee in the world in those Franco-Nevada and Wheaton Precious, and you have high gross margins like their Microsoft. And they have put in policies as the gold and silver rises that they're going to pay out a higher dividend. So you're going to get both capital appreciation and rising dividends.
Rick?
I'm sorry, did you call on me?
I did, yes, sir.
I don't think there's a one-size-fits-all answer for all investors. My suspicion is that almost every retail investor in North America is underweight the whole gold sector. And my suspicion is that many of them should start with gold itself, either in physical form, or my preference, of course, would be the Sprott Physical Gold Trusts on the New York Stock Exchange. But understand that's just a preference. In terms of the initial foray into the gold equities, I would echo what Frank said. The royalty and streaming companies are believed to be overpriced on certain metrics, including EBIT to enterprise value. But I would suggest that an 80% margin business deserves a higher price EBIT ratio than other types of enterprises. For investors who would like greater participation in the gold equity sector, including the risks, there are several fine precious metals oriented ETFs, including a couple by Sprott. You could also pay attention to the old thesis about mining suppliers, which is to say suppliers of financial services. I note that both U.S. Global and Sprott, which provide financial services to gold investors, are also publicly traded and are an interesting non-capital intensive way to play a gold bull market.
Gotcha. And Adrian, I apologize again. I know it's hard to peg just into one thing here, but again, if you go and you got that first $1,000, and you know you want to speculate on gold or invest in gold, where are you going with that?
Right. I would always recommend to people that the base should be gold bullion, or as close to gold bullion as you could possibly get. That's what you should have first. And you shouldn't even think about exploration stocks until you have some senior stocks, and you shouldn't even think about senior stocks until you have gold bullion. So bullion is the first. And obviously it depends. If you're putting, if your allocation to the security and the safety of bullion is $1,000, then you buy a gold bullion ETF. You don't buy bullion. But if you're putting in $1 million, you buy bullion. So that's number one. Now, once we get past that, I mean, I agree. Frank laid out the case, so did Rick, very much. I mean, the large gold royalty companies, such as Franco, Wheaton, have very good exposure to the upside of gold. They may not be the best performing stocks in a strong gold bull market, but they have very good exposure to the upside, while at the same time, both as businesses and as stocks, they have very low downside. So those would be the next thing I would buy. And then, frankly, I'll quote Rick, don't buy hamburger when the filet's on sale. And right now, to me, the filet is on sale in terms of the large, big caps mining companies like Agnico and Barrick, and both Canadian companies. See, I'm trying to mention Canadian companies here. But those things are on sale. Now, I'm not saying the exploration companies are not on sale, but again, when you can buy big cap equities that have much more certainty of going up in a gold bull market than do the exploration companies. And let me just mention one thing that a lot of investors need to understand if they're new to this sector. Both Rick and Frank mentioned the volatility that is inherent. But there's another aspect to the gold business that's a little different from some others, like consumer and durables and so on. And that is that gold stocks are probably just about one of the most idiosyncratic sectors out there, meaning you can have a strong, gold can go up, but individual gold stocks may not go up. And if you look at the last 6 months or the last 12 months, for example, even if you look at the XAU, you see which is the U.S. index of large cap gold and silver miners, you see several stocks that did very well, 50, 60, 70%, and you see other stocks in that large cap index that actually have lost money over the last 18 months. So the selection of stocks you buy in this sector is absolutely critical. And that's why I'm not a huge fan of broad-based ETFs. Now, both of my colleagues, their firms actually have very, very good ETFs that we do hold for our clients. And I say they're very good because they actually have criteria on which they select stocks. But I'm not a big fan, and I won't mention names, but I'm not a big fan of ETFs that just sort of put in everything just because they're big, because you're getting the good and the bad and the ugly all together.
Well, thank you, Adrian.
Good merch plug. Right on. And you can jump in here, but the first part of my question and I'll start again with you, Frank, because Adrian, you mentioned picking juniors, picking exploration. Rick, you made a great point about suppliers, but there's this whole initiative, Mining Over Canada, is really a tip of our hat to the explorers of the world, specifically Canada. And if you're going to look at Canada and you're going to look at maybe a region or look at a certain play, I'm curious if your heart tugs towards a certain style of exploration program or a certain region in the country, and if maybe you would even put your money into that idea over something else. And again, if you can answer that, go for it. If not, that's okay.
I'm trying to be concise for you.
I know.
I would just say this for you, that I am very bullish, and I've not been very bullish on gold stocks in over a decade. And I started to truly turn bullish in March. And if we look at 100 gold producers around the world, and what happened this time last year is that the median had a negative free cash flow yield. The S&P had 2.5% free cash flow yield. Come along fast track March, that quarter end, the S&P lost its free cash flow yield, but gold stocks went positive. And gold stocks grew stronger in June, and they're at record free cash flow yields at the end of September. I believe that the CEOs of the majors and the Yamanos of the world are all advocating the discipline, executive discipline and board discipline of having a free cash flow yield, which means to investors that they can raise the dividend, they can buy back the stock, or they can acquire or build out another project. They have options to themselves. And so I think that the industry as a whole will continue to attract more eyeballs. This summer, Investors Business Daily, which predominantly uses the CAN-SLIM model, which is a sort of a quantamental approach, it was highlighting Franco-Nevada. It was highlighting Kirkland Lake. And I thought that was the most fascinating, because they're now in the same group as Zoom, the same group of stocks for IBDs recommending, like NVIDIA. And I think we're going to see in Lowe's and Home Depot, we're going to see those growth stocks. Gold stocks today are positioned to be growth stocks. And it reminds me of about 2005 when we started to see this with a lot of the gold producers. So I think we're going to get a bigger audience than just gold investors that they always look for the discipline of free cash flow. So I remain very bullish on the sector. What we have seen is that more money is going into the smaller cap, and I think it's because there's greater confidence in the big cap. And Buffett buying Barrick, which has a decent free cash flow yield, it just creates a slow sea change in the capital markets for the gold producers.
Cool. Sorry, Rick, I'll let you wade in there if you'd like, if you have anything to add on juniors specifically, and what gets you excited about one over another. If you were to go to PDAC this year, what booth would you gravitate to? What would they have to say to get Rick Rule to drop by and say what's up?
So this isn't a Canada-centric question anymore?
If you can make it Canada, start with the Canada section and then go global if you'd like.
Well, what's interesting to me about the industry in Canada is that Canada has centers of excellence in mining. It isn't merely mining in Canada that's important to the Canadian mining industry. The regulatory infrastructure, the financial services infrastructure, the technological infrastructure means that both Toronto and Vancouver are exporters of scale and technology to mining businesses around the world. The Canadians need to understand that they have done in mining what Silicon Valley has done in some other aspects of technology, and be proud and acknowledge that. That's the first thing. The second thing, which flies under the radar, is that particularly in British Columbia, the relationship between the industry and Indigenous and Aboriginal communities has come a tremendous way in 25 years. And the processes by which this took place and the products that are being created, the mutual trusts that are being created, give Canadians a durable competitive advantage in dealing with Indigenous communities around the world, which I think is important to note. Back to the secondary question, how does somebody attract my attention at PDAC? Given that we invest across the scale, we are particularly interested in the skill sets of the management team and the track records of the management team. I've noted in several interviews that if I had just stuck to the management teams that had rewarded me the best in the decade of my 30s, the 10 best management teams, I would have worked half as hard and made twice as much money. So a track record of success, but importantly, a track record of success that is appropriate immediately to the task at hand. If somebody is a developer, be a developer. If somebody's an explorer, be an explorer. If somebody's a turnaround artist, be a turnaround artist. And I want to know not just about the success of the CEO, but how the board was chosen and why. And I like management teams to be owners. I am certainly very fond of some unpopular subsets, the prospect generator or the royalty generator in the earlier stage companies being key components of that. I am also, unlike many, much more willing to tolerate perceived political risk than I am technical risk, which is to say that I would prefer a tier 1 project in what is perceived to be a tier 3 jurisdiction I'd rather develop something that's worth stealing than develop an asset that nobody in their right mind would want to steal. So I guess that's how I would.
Yes, and if anyone's followed Rick's history, I think he's backed that that mindset up quite a bit. So
Rick, you're saying you're betting on the jockey, not the horse.
It seems to me that the jockey can pull along a horse, Frank. Yes, absolutely. If a person who I don't like so well or don't trust so much stumbles upon a tier one asset and the asset is too cheap, I'll probably swallow twice and look. But in terms of being able to back a team for 5 years or 6 years or however it is that long usually takes to get the kind of reward that you need to take to be in an industry as risky and volatile as mining, I prefer a Lucas Lundin, a Bob Quartermain, a Ross Beatty, or Robert Friedland,
Right. And I do appreciate, and I'll echo what you've said about just Aboriginal First Nations relations in Canada, the standards we have set and are working towards. In Mining Over Canada, a lot of our content, we heard about the dialogue that continues to happen and how it's important that we do things ethically, or at least with consultation with First Nations, so that we're not taking some of the liberties you may see in other jurisdictions. So I think for investors, that might be something that's very important to understand. Now, Adrian, I'll let you just finish here on this thought, but Canada, investing, juniors, you did touch on it in a bit, but is there anything that gets you particularly more focused on a company in Canada or even in the junior space that is a hallmark of a good operator versus maybe one who's not?
Yeah, no, absolutely. I mean, and first of all, I mean, despite my comments about, hamburger and filet, I mean, we have a lot of juniors and a lot of exploration companies in our portfolios. I'm very, very keen on that sector as well. And I think it's important that we recognize that this industry, this sector is absolutely critical to the gold mining business, because we know that new discoveries are going down. We know that production probably peaked last year for the next several years. And new discoveries are going down, and most of the senior companies do not do any greenfields exploration anymore. They have sort of farmed that business out to the juniors. So it's critical that this sector, is supported. And the other thing we have to recognize, of course, is that the odds are very, very much against exploration companies and a traditional type of exploration companies that raise money, drill some holes, raise some more money, drill some more holes, very much against you. So there's a couple of things that I really focus on. Number one is people, as has been said. And I often tell people that I would rather a good management team with no cash and no decent property over a great property with a lot of cash and a lousy management, because the lousy management will steal the money and, polite word, mess up the property. So as Frank put it, the jockey you'll find a good management team, if the property's bad, first of all, they'll walk away from it quickly, which is essential. And that's something we don't think about too much. We focus so much on success, but the other part of it is things that don't work out. And a good management team knows when to walk away and preserve their money and go on to the next shot. So what is good people? Well, good people are people who've, had experience, who've done it before, who are honest with the market, who are honest in telling the market what's not going right as well as what is going right. So people is number one. People is essential to me. Number two is balance sheet and everything that implies. Companies that have no money and have to keep constantly raising money, companies, and that means dilution for shareholders, companies that have spent too much of the money they do raise on G&A, including salaries. That's another sort of thing to look at and watch. You want companies that either have good balance sheets, or when they do raise money, put that money into work, put that money into the ground, not into salaries. That's another factor. So people and balance sheets are the two most important things for me.
Perfect. Okay, well, we appreciate that. Let me just shift gears a little bit. And again, I know some of these questions weren't thrown to you before, but I know you can answer them. They're pretty basic. A lot of what we talked about mining over Canada, what came out, and it came out on this panel, is that mining all of these precious metals, these battery metals, all of these utilities, we need these phones. We need this computer. When it works, it's beautiful. We need to get this pandemic sorted out. It's going to require medical equipment. But the one thing Richard talked about was battery metals, and that's the one that seems to continue to come up with the Teslaification of the world, and the I guess electrification of the world. Now, Frank, I know I've seen you on stage talk about this, and have differing opinions about it. But battery metals, what's your outlook next year? Are you seeing Tesla and companies like that just continue to grow their footprint and require more of these metals? And is the world going to have to continue to meet their demand? Or maybe do you have a contrarian view to how that's all breaking down?
No, I think that the demand for rare metals and earth will continue to grow. When you see the CRB index is up 18% for commodity demand. Well, if you start looking at some of these specialty metals, it's even greater. One of my favorite gold stocks is Hochschild, because they have the largest rare earth deposit in Chile they're developing, in addition to producing a lot of gold and silver and having the cash flow from it. And it's that thought process, because I believe that we're going to continue to need these metals. So I remain very, very bullish on that end of it. The other thing about mining that's been a boom, also interesting enough for Canada, has been crypto mining, not just gold mining and other metals. And I know I'm chairman of a Hive, and we just doing an acquisition for 50 megawatts in New Brunswick. And so this you have green energy in Canada. You have inexpensive on a relative basis. You have a safe jurisdiction. So it's also what you're seeing coming in is equipment from outside, buying it from China, and then employing people in Canada to use stranded electricity. There's pockets of it. So I think it's, to me, fascinating. It's not just the rare metals that's getting mined.
Right. And you're going to bring up crypto. So, Rick, how many crypto servers you got running in your back office there? What's going on?
Been there, done that.
You could answer the original question. Just are you along for the ride on battery metals and the thesis there, or are your spider senses tingling? Is something happening that's maybe contrarian to what the world seems to be focusing on here?
I'm somewhere in between. My favorite battery metals are ones that have great big markets, like copper and nickel and cobalt. Will I play the rare earths in the right circumstance? Absolutely. But, it's important to note that the rare earths aren't really very rare. It's important to note, too, that China dominates that industry because China is the most efficient. As the Chinese state becomes less tolerant of the environmental degradation of Western China, the costs associated with producing those rare earths in China are going to increase. And any part of the world which is prospective for those, including, of course, the Canadian Shield, I think over time will do well. The whole sort of hype around the Tesla thing is interesting, but I think investors need to think more in terms of the electrification of the rest of the world. 1.2 billion people without access to electricity. Urbanization, which is the process by which the 2 billion poorest people on Earth become less poor. And then the whole distributed power, which is a fancy way of saying sort of battery revolution, is occurring worldwide. If you take me away from Tesla, Monk being probably even a better promoter than Robert Friedland, and you replace that thesis with the ascent of humankind, I'm all behind it, but I'm all behind it on a risk-adjusted net present value basis. Narrative don't spend, as far as I'm concerned.
Adrian, anything to add to this? Sorry to keep you last every time. I'm sure you had.
You have a problem. The problem with being third after two great minds, and I really truly mean that. They're friends, but they're great minds. Is there's not an awful lot new to say, but when it comes to the and Rick touched on it, when it comes to green energy and electric vehicles and so on, I like copper and nickel. I'm a big fan of if you like, adapting Occam's razor to investing, and that is if there's a simple way of investing in a thesis, go for the simple way first. Copper and nickel are definitely going to be beneficiaries of green energy. You can look at rare earths and maybe you know where all supply comes from. Maybe you know what new mines there are and what China's cost of production is and everything else. But you've got to look into all of that, what the what the possible substitutions are, and so on. But copper and nickel, we know, will benefit from the green energy revolution, and they will also benefit, particularly copper, from infrastructure spending. Yeah. So we've got infrastructure spending in China. We've got, with the new administration in the U.S., maybe infrastructure spending here. I mean, every administration for the last 40 years has talked about renewing America's infrastructure, but they only look out 4 years, so they never do it. But maybe this one will. But infrastructure spending is positive for copper, number one. And the green energy revolution is definitely beneficial for copper. So again, Occam's razor, stick with copper.
Stick with copper. Now we're just about the end of our journey here today, mining over Canada. Maybe just share with me, and I'll start with you this time, Adrian. But it's been a tremendously disrupted year, and I know we've touched on a lot of these macro issues, but you, from how you operate and think, how has COVID changed? How has the pandemic changed your outlook on investing and in your philosophy of investing? Has it been impacted by this unprecedented black swan, if we can call it that, event this year? I'm just curious to get in your minds a little bit before we sign off today, because knowing how you react to this would really help. And
around the world. There hasn't been a lot of, we could argue about this week or that last week, but by and large, the currencies haven't really been affected much by COVID, how much COVID is in a particular country at any given moment. So the interesting thing to me is just how little the markets have really reacted or been affected by COVID. But the one central thing that has happened, of course, is central banks have increased stimulus and, gone from easy money to excessively easy money to ridiculously easy money. And, we know what happens when they do that. The stock market goes up because excess money has to go somewhere, and most of it goes into the stock market, and gold goes up because excess money depreciates the currency. So I'm not sure if I answered your question, but...
no, I mean, you affirmed very... base, but important points about how you should react maybe in a situation like this. So I think that's great. That's a great point to end on.
Well, one last thing though, yeah. I think it's important too many investors react. Yeah. And people have got to get out of the habit of reacting to things. I mean, today everybody wants to get out of gold because gold is going down, which is just precisely when you shouldn't be doing that.
You've just answered one of the questions in a roundabout way. No, that's great. No, from the session. Rick, second last comment here. Are you still the same Rick Rule investor from 8 months ago?
If you're referring to COVID, yes. Ironically, it's improved my life as an investor. I spent 40 years flying every 7 to 10 days. I hadn't understood the wear and tear on my carcass of going through all those time zones and dealing with all those transportation safety morons. So the fact that I can participate in this conference from the comfort of my own office without subjecting myself to the indignities of travel has been nice. It's also let organizations of the Sprott size know how over-reliant we were on central business district or high-end office real estate when highly functioning employees function well from home and low-functioning employees don't function well anywhere. So I think in those two regards, COVID has actually been useful. I don't think that the market particularly has taken note of the impact of COVID on the overall economy. Primarily, I suspect, because the policy response to COVID, like the policy response to any other ill, is excessive liquidity, which is papered over in difficulty. And my suspicion is in the next 2 to 3 years, we will experience some backdraft from the overall cost to the economy, the world economy, applied by global. But I would by COVID, pardon me. But I would suggest that the near-term impact for me as an investor has been to finally force me to understand a little better how to use technology, both in terms of communication, but also research. And as I said before, it's reduced my travel, which has benefited me greatly.
Yeah, I hear that. And seeing as Frank, the last time I saw you was at the top of our office, at the top of First Canadian Place, 72 stories and on top of Bay Street. I'm here in my basement doing this. How's your life changed? Your mentality changed as a result? And you've got the final word, so looking forward to hearing it.
Since we were last together, I drove down from Toronto to Texas, and have been blessed to be here. Not stuck in Toronto. I quit drinking. I took up additional running, so my cholesterol fell from 200 to 150. I started thinking, what happens if I get sick? I'm 65, and what's the math? So I just really became more personally health conscious. And then I was blessed by this. I've learned so much about the millennials. It reminds me of the 90s when baby boomers discovered tech stocks and mutual funds. And now we have this whole new audience of investors that are discovering mutual funds. No, they're not. ETFs, only ETFs. And stocks, individual stocks, and the millennial phenomena. And I've been blessed to see my Jets ETF get halved in February, and then go from $35 million to $2.5 billion in assets during this period. So I've been very fortunate. My gold investments, they've also appreciated substantially. I think that in looking forward, one of the things is as an investor, advice is to dust off Peter Lynch's One Up on Wall Street and look where industries that you're using or big contrarian bets, such as the airlines industry. And there was such a big contrarian bet. And when I talk about One Up on Wall Street, I'm looking at, I was driving by in March and seeing all the parking lots empty except for Home Depot. It was packed. And started running the models and look at it. And so we bought Home Depot and Lowe's, and these stocks have been phenomenal performers in a COVID world. So you look at which companies go bankrupt, which ones don't. And one of the biggest things I see as a precursor to growing revenue is who's hiring. If someone is hiring someone like Amazon did in March, they're hiring 100,000 people. Then they did it again. So that is a real true precursor for investment advice. Dust off his book or go to YouTube and you can see lots of book summaries of it and apply that to your investment thesis.
Beautiful. Well, gentlemen, I hate to stop you here, but I have to because we have another session coming up. Those who are watching, I am going to send a redirect link to the next session with Graham Preston and other luminaries from the industry. Gentlemen, I can't say it enough. We really appreciate you coming here today and joining us with your precious time. And from the CSE and from the Mining Over Canada initiative, thank you for contributing to our body of work. We're very proud of what we've done here and very proud that you could be a part of it. So once again, thank you. And we'll see you again soon, probably on a computer before in person, but truly appreciate it and hope to see you at some point in the near future.
Thank you.
Bye, Rick. Bye, Adrian.
See you.
Bye.
Great.
Good to see you.